Hi everyone, thanks for joining today's webinar, which is our Getting Started tutorial. Our speaker today is Ernesto Perez. He leads community support at Quantopian. His role is to assist community members by answering platform and API questions, sharing research and algorithm examples, and providing guidance for new members. He collaborated on the redesign and development of our new Getting Started tutorial, as well as the Futures tutorial. Ernesto's background is in computer science, and he graduated with a Bachelor's of Science degree in Electrical Engineering and Computer Science from UC Berkeley. As a reminder, today's webinar will be recorded and posted in the next coming days on our website. We also invite you to ask questions throughout this tutorial about the things Ernesto's talking about. He'll be answering questions throughout the presentation, and then, as always, we will reserve 10 to 15 minutes at the end for Q&A. Thanks, Ernesto.
Thank you for the introduction. Hello, everyone. Today we're going to be going through the Getting Started tutorial on Quantopian. This tutorial gives you a pretty broad overview of the entire platform and all the tools available to you. It is for new community members as well for experienced community members. You might find a tool that you haven't used before or a new approach to a research problem you've encountered in the past. So let's get started. If you are in the main site, you can go to Learn and then click on Get Started. That'll take you straight to the tutorial. One thing to mention is you'll need basic Python programming skills for this tutorial. The tutorial only covers Quantopian's API, so if you're not familiar with the Python programming language, just take a brief introductory course and come back to this. So let's start with what is a trading algorithm. The tutorial describes it as a computer program that defines a set of rules for buying and selling assets. Another way of thinking about trading algorithm is to define it as a function that takes in financial data like pricing or fundamentals data, and it outputs a set of orders which would compose our target portfolio. So most trading algorithms make decisions based on mathematical or statistical models. We've defined these models by conducting research on historical data. So where do we start? Commonly, a quant researcher would start by collecting historical data, cleaning it, and then their actual work would begin, which would be analyze the data and come up with a statistical model that they can use to describe the market, or they can use to model the market. In Quantopian, all of the data sets are integrated into the platform. All the data has been cleaned for you, and all you need to do is get started. All you need to do is just get started on the actual analysis of the data and diving into all the data available. So one quick example, here we get some Quantopian specific functions. The prices function just it's a way to query pricing data in the platform, and the symbols function just returns. You type in a ticker or an asset symbol, and it returns the identifier within the platform. So what we can do here is we can clone this example by going up here and clicking Get Notebook. This will take it to the research environment, which is built on top of the Jupyter Notebook environment. Jupyter Notebooks are pretty much an interactive Python interpreter, and they just offer a really easy way of analyzing, visualizing data, and a way of saving your work to make it reproducible. So what do I mean by clean data? So typically, when you're collecting data from different vendors, they might have different symbology for the same asset. So one way of saying that data is clean is mapping assets across data vendors. Make sure that when you query, I don't know, pricing data for one asset, and then you want to query its fundamentals, that the symbols match, or not just its symbols, but the identifiers. Another question is, what's the difference between research and algorithm? So in the research environment, it's a more free-form environment. You can, it would be pretty much like typing Python code into an interpreter. The algorithm environment is the backtester, which is where you would be running your algorithm through, you would be running a simulation on your algorithm to look at its performance over time, over historical data. But I'll cover that a little more in depth in another lesson of the tutorial. So here we can click on Get Notebook. It'll initialize the notebook, and then you can see the kernel starting here. Once it's done, we can go through the cells by clicking Shift Control. That executes the cell. It doesn't do much. It doesn't do anything for markup cells, but once we get to the code, you'll see it's executing, and then we get an output. And here we're just seeing a simple example where we're querying pricing data for Apple over 3 years. We're computing the rolling mean for 20 and 50 days. And then we're plotting all 3 series together. Let's continue with the tutorial. So in the second lesson, see another example for returns data. Here, Quantopian provides pricing and volume data for over 8,000 securities from the start of 2002 up to the current trading day. In the research environment, you'll find some utility functions like returns or the prices function we used in the previous lesson, the symbols function again, and let's see. Let's clone this one as well. This will simply return pricing data over the entire period we define. Now, on top of pricing and volume data, Quantopian integrates a number of alternative data sets. Some examples are fundamentals from Morningstar, trader sentiment, trader mood, news sentiment data, event data like earnings calendar, some macroeconomics data, and all of those you can find them in quantopian.com/data. All of these data sets can be accessed through the Pipeline API. So what the Pipeline API does, it allows you to query data for a large number of assets and manipulate it in a single data frame. For the tutorial, we'll use the stock to its trader mood data, which is, it takes tweets from the stock to its platform, which is a financial communications platform. It analyzes the mood of that message, and then it aggregates the mood from several thousand messages to create a score per asset per day. Here we're going to be using the bull and bear scores, which is the bull score pretty much, it's the expectation of the asset to go up, and the bear score is the expectation of the asset to go down in price. This data set is provided by stack signal, and you can access it from the data page. Yep. So I think I already answered that. My bad. Yeah. So again, the dataset we're going to use for the getting started tutorial is stock twist trader mood from stack signal. And specifically, the factors that we're going to use are bull minus bear scores, which I'll cover in a bit. So here, this is an example of a simple data pipeline. Here we're computing the returns for all assets. We're querying the bull minus bear score from stock tweets. And we're getting the message volume from stock tweets as well. Just to give a quick example, we'll want to run this cell. I already had it, yes. And we'll filter out, in this example, we filter out the data for Apple, just so that you can visualize what a quick view of the data provided by stock tweets and the returns data. So this is what the output of the pipeline will look like once we plot it. And here you can begin to see some trends, like some spikes on daily returns when there are spikes on message volume on stock tweets. And then on sentiment, sometimes you see some matches between the spikes in returns and sentiment data. This is just an example. You would want to conduct a more rigorous statistical test on your data, and that's what research is there for you. It's a perfect tool to conduct research on alternative and pricing data in Quantopian. So in the next lesson, we're going to look at the pipeline API in more depth. So again, the pipeline API is just a simple way of managing large numbers of assets in an efficient way and querying data for them. And it allows us to select assets based on filtering rules, rank assets based on some scoring function, which will, I'm sorry, which we'll use, oh my God, I don't know what's,
1 second, we're just getting
1 second, I'm sorry.
Fine.
I'm dying here. I'm sorry. So yeah, we'll use ranking in our strategy to choose which assets we'll be selecting to trade and which ones will not. And you can also calculate portfolio allocations with Pipeline API. So to begin, you'll need to import the pipeline class from the Quantopian.pipeline module. And we usually wrap our pipeline definition in a function. This makes it really easy to move our pipeline definition around between the research environment and the algorithm IDE. The second step is to put some data into our pipeline definition. Here we're going to import the US equity pricing data set, and we're going to get the closed price from the pricing equity data set. So what we do is we import the data, we reference the close price, and we get the latest value. And this is the factor that we're actually inputting in our pipeline definition. Now we create our pipeline class, and we specify the columns that we want to output. Now to add our stock tweets data, we'll need to import stock tweets from the SAC signal dataset. There are some, the pipeline API provides some built-in functions like simple moving average, the returns function we saw in the previous lesson. So we'll want to compute a simple moving average over the previous 3 days of our sentiment scores. We can do that by importing the stock tweets dataset again, our simple moving average factor. And then we specify the calculation, simple moving average. We specify the input to be the bull minus bear score sentiment from stock tweets. And we specify a window length of 3 to calculate over the previous 3 days. And as before, we add the closing price and the sentiment score to our pipeline definition, and we return that. Now, one of the things that pipeline, one of the important features of pipeline is that it allows you to downsample the entire universe of assets available in Quantopian using filters, and that allows you to select assets based on some filtering functions or some data. For example, you can, if you want, you can only trade assets that have a 500 minimum market capital. I don't know, have a closing price above $16 or stuff like that. In Quantopian, we provide a pre-built trading universe called the Q Tradable Stocks US, and what it does is it has a series of filtering criteria, and most important thing is that it allows you to, it makes your algorithms, how do I say this? It excludes assets that are difficult to trade, so and that's an important part in your algorithm. You won't be able to trade your algo if it trades on assets that have low liquidity or stuff like that, and the Q Tradable universe takes care of that for you. So we'll use that in the tutorial. So again, we have the same pipeline definition we had before. Now we import the Q Tradable Stocks US. We set that as our base universe, and we use the pipeline screen in our pipeline definition. And what this does is it takes assets that are only, that the output of our pipeline will consist of assets that are in our tradable universe. And again, the way you would execute the pipeline in research is by using the run pipeline method. So we would want to import run pipeline from the Quantopian.research module and specify a range to run our pipeline on. And the output of our pipeline is just a pandas data frame. It's indexed by date and by asset, and then it contains the columns that we added to our pipeline definition. which are, in this case, the close price and sentiment score. Now, this allows us to create in the next lesson more, how do you say it? More fleshed out strategy. So for this tutorial, we'll do long-short equity trading algorithm, which is going to be the focus of the upcoming contest. A long-short equity trading algorithm doesn't, how do I explain this thing? Pretty much just tries to go along on securities that you expect to go up in price, and then it shorts securities that you expect to go down in price. And the way that the core of this strategy is for you to come up with a model or a function to predict the direction that a given asset will take. Not so much the price, we just want to predict the direction. That makes it a lot easier. That simplifies the problem for you. So here, what we do is we pretty much just define our strategy to be, we're gonna go along on assets that have a high 3-day average sentiment score, and we'll short assets that have a low 3-day average sentiment score. For this, we can simply use the pipeline we defined before. We'll use the Q-tradable universe as our base universe. We need to compute the 3-day moving average on our sentiment score, which we get from stock tweets, and we'll output that as our asset score, if you want to call it that. Now, for this lesson, we're just gonna look at the extremes of the scores. Oh, my bad. Oh, my bad. I skipped that question. Okay, so the granularity of our databases. Pricing and volume data are minute bar, and our alternative data sets are daily bar. Sorry, I'll continue with this. For this lesson, we're going to analyze our strategy, but we are only going to take a look at the extremes of the assets that have the 350 top and bottom assets that have the highest and lowest sentiment scores. So we do that by creating a filter. We take our sentiment score and we call the .top attribute method. We used an OR statement to an OR operator, my bad. And we combine it with the bottom 350 assets. And we set that as a screen. Now, to run an analysis on our strategy, we'll need pricing data for all the assets in our data pipeline. So we'll want to select a period, run our pipeline, and then query pricing data for all the assets in our pipeline output. You can do that with the prices function from the research module. And this is just a quick hack to get all assets in our pipeline output. Now, to analyze our strategy, we'll use Quantopian's AlphaLens tool, which is a factor analysis module. And to run an analysis using AlphaLens, we'll need to combine our pricing data with our sentiment scores for all assets that made it through our pipeline. For that, we can use the get clean factor and forward returns. And just let me click on this real quick. You can find more info in our factor analysis. You can find more info on AlphaLens on our factor analysis lecture later on if you want. This is a really good lecture to go through. So we can call the get clean factor and forward returns, and that'll just combine our pricing data and sentiment score data into a single data frame that AlphaLens can consume and process easier. So this is just an example of some of the analysis you can do with AlphaLens. Here we're looking at the mean returns by factor quantile. What we're doing is we're separating our sentiment scores into quantiles, in this case just 2. And we're specifying holding periods of 1 day, 5 days, and 10 days. And we're looking at the mean returns over time, over the period that we run our pipeline on. So here, what we would want to see is assets with a low score getting negative or low returns, and assets with the highest score getting positive or yeah, just higher returns. And we see here that that is the case for our strategy, so that's 1 point for that. It's great. But then looking at this graph, this is a factor-weighted Longshore portfolio cumulative return. And we can see that there is a long drawdown period and the strategy doesn't look all that great. This is just taking into account the pricing data and our sentiment score data. If we were to weight, if we were to buy an asset based on its weight, based on its sentiment score as weight, and you can run this analysis with the factor returns, then plot cumulative returns from AlphaLens. Now, for the sake of the tutorial, we'll just continue with our strategy as it is, and we'll see how it does. But one thing to keep in mind is that this does not take into account slippage and commissions, slippage and commissions that an algorithm trading live would have to take into account as well. But we'll look at that in a future lesson. What you would want to do in this case would be to go back and refactor your strategy and then run AlphaLens analysis on it again until you see a better performance. Well, let's just continue with this. So now we'll go to the IDE, or the interactive development environment, and this is where we'll actually run our trading. We write our trading algorithm, and this is where you simulate your trading algo on historical data and see how it performs. This is just a quick view of the IDE. Now, algorithms built in Quantopian have a certain structure to them. So let's look at the core functions that make up a trading algo in Quantopian. All algorithms need to have an initialize function, which is where you set all starting logic or initialize any variables that your algorithm will use, any parameters. And also, it's where you set the scheduling functions, which is when you'll run, you specify when the time intervals in which your algorithm will execute its trading logic. It takes in a variable called context, which is where you save the state of your algorithm. And this variable is Python, an augmented Python dictionary, pretty much. You can store into it any any results of an analysis that you want to carry throughout functions. Another function is before trading start. This is run 15 minutes before the start of the trading session, which is 9:30 a.m. Eastern time for equities, for the equities calendar. And here is also where you would get where your pipeline would be executed, and you would get pipeline any asset data you specified in your pipeline definition. We'll get into that later. We'll get a little bit more into that later. Another core function is the scheduling function. And this one is pretty much what I mentioned before. You would use it inside initialize, and it allows you to specify the time and date that you want to execute one of your functions or trading logic. So here, one example, we're going to execute our rebalance function, and we're specifying a date rule at the week start, which will be the first day of the week. They say the first day of the week because of holidays. So it could be on a Tuesday, not necessarily on a Monday. And then we specify a time rule, which is market open, which would be, again, 9:30 a.m. Eastern time. If you want to take a look at all the date rules, time rules, you can check out our documentation, and there's a lot of really good stuff in that page. Okay, I'll continue with this. So here's an example algorithm. It doesn't do much. It just prints out messages depending on what day or what time of the day it is on the simulation. And to create a copy, you can just click here on clone. It will take you to the ID, and it will make a copy for you. So here's our code. We can run a backtest using the build algorithm button or the run full backtest button. I'll show you the run full backtest button in a little bit. So here, run quick backtest. See, it doesn't do much because we're not placing any orders, but here we see the logs and we see that it's printing a message on day one. Then it executes our rebalance function and prints out a different message then. Then before trading start on the second day, it prints out a different message, so on and so forth. So now the important part, we saw this is the basic structure of an algorithm. You have your initialize function, we store some variables in our context, and then we schedule a function to run at a specific time. And then we can use the variables we stored in context in different functions. And that's it. So next up, we would want to add our data pipeline from research into our algorithm to get some asset data and start trading some assets. So here, the pipeline definition can be ported from research without changes, which is great. The only thing that changes is how we execute the pipeline in an algorithm versus in research. So if you remember, in research, we'd use the run pipeline method. In here, instead, we'll use the attach pipeline, which is pretty much just attaches the pipeline definition to our algorithm. So here we import attach pipeline from Quantopian.algorithm module. We use it in initialize. This is really important. You have to attach your pipeline initialize. You give it the pipeline definition and a pipeline name. The pipeline name can be any string you want. It's just for you to remember. you have our schedule function again, and we removed the code we had before trading start and balance because we're going to start building our trading algorithm. So now to get the output of our data pipeline, we would use the pipeline output function, again from the algorithm module. And we get our pipeline output inside before trading start. And all you need to do is call pipeline output and then provide the string name that you specified in attached pipeline. It's pretty straightforward. And here we are gonna add the output to our context variable so that we can use the pipeline output in other functions, specifically in our rebalance function. So here we can clone our algo. This one will take a little bit more to backtest because we're getting more data for a lot of assets. But I have an output here already for you, which is, it's just getting the pipeline output and printing out the top 10 scores for assets each day. See here in the logs, we can see a couple of days of data. No questions. Cool. All right. So in the next lesson, we'll add actual trading logic to our algo now that it has the data it needs to analyze assets and choose assets from. So here, portfolio management. This is a really cool lesson. Here we see how to use the portfolio optimization API in Quantopian. It's called the Optimize API. And what it does, it allows us to specify a set of rules that we want our target portfolio to follow, and then we just need to pass in some ranking or some scoring of our assets, or how we believe the assets are scored, and it computes an optimal portfolio for us to invest on. If you want to learn a little bit more about portfolio optimization, again, you can click in here and I'll take you to our help page. It has some really cool examples and a really good definition of what the optimizer does under the hood. Yeah, so to use the Optimize API, we need to import it from Quantopian.optimize. And we'll use the maximize alpha objective, which is takes in a vector of assets and some value associated with them, and it weights the assets based on those values. So we're gonna use the sentiment scores as our weights, and we'll be passing our sentiment score here to maximize alpha. Some constraints, we would want to put some constraints on our target portfolio, like maximum leverage. We wouldn't use more than 100% of our available capital. Another constraint we can use is maximum position size, which just prevents us from investing too much money into too much capital into a single asset. And here we set a max turnover constraint, so that we don't trade our entire portfolio in a single day, or so that we don't try to trade our entire portfolio in a single day. Now, to actually place orders, we need to use the order optimal portfolio function, and we import that from Quantopian.algorithm. And we need to initialize. We need to set our constraints as well, similarly to how we initialize our objective maximize alpha. The optimize module also has position concentration constraint, dollar neutrality, so that we invest the same capital on long positions so that we have the same ratio of long to short positions. And we set a max gross exposure as well. So here we add everything to our rebalance function, have our objective, our constraints, and we call order optimal portfolio, passing that objective and our list of constraints. So now this is all the trading logic you need. Now we need to put it all together. No. So another thing that the Optimize API does for you is it allows you to the same thing as placing constraints on our target portfolio. There are some common risk factors that we want to avoid investing on, and the risk model, Quantopian's risk model, provides asset. What's called that? Provides asset attribution to these common risk factors. So there is a special optimized constraint we can use. It's called risk model exposure. But let's see how we can get the risk model data into our algorithm. So here we get the risk loading pipeline, which is pretty much a function that returns a predefined pipeline. We would attach it the same as we attach our data pipeline to our algorithm inside initialize. And then we would get its output inside before trading start as well. And this is no different than the data pipeline we provided. It's just a pre-built pipeline definition that Quantopian provides with risk attribution data. So here we would set a risk model exposure constraint, and we would want to pass the output from that pipeline, which we called risk factor betas. Here we can clone this algo, and we could run a quick backtest or run a full backtest. So now I'll show you running a full backtest on this. This one will take a little bit, so I already have one here for you. So this is what it'll look once the backtest is done. Here we can see some metrics calculated, total returns or benchmark returns, in this case 5, alpha, beta, or Sharpe ratio. Have transaction details for each day, for daily positions and gains. And the most important and cool thing is that you can do a deeper analysis in your backtest data by clicking on this button, Analyze Backtest. This will create a notebook in your research environment. Did I go too far? Yeah. So this initializing. So the get backtest function is a special research function that you need to pass in your backtest ID, which you can get from the URL in your full backtest page. And it calls a create full tier sheet function, which first loads all your backtest data into research, and then it generates a very detailed analysis of your backtest data, which I have run here. And I think I didn't go over it too far. Yeah. So that was the next lesson. My bad. Backtest analysis. So you click on analysis backtest, analyze backtest, generate tier sheet, and these are some of the sample plots that you'll see in there. The rolling portfolio beta. This is how correlated is our portfolio to the market over the entire backtest period. And this is performance attribution. This uses Quantopian's risk model again to see how much of our portfolio returns were attributed to the common risk factors I mentioned before. So here, this is the tier sheet. Gives you some summary statistics, max drawdown over the backtest period, Sharpe ratio, or gross leverage, which is pretty good given that it's within the range that we constrain our portfolio. Then it shows cumulative returns, or portfolio returns against benchmark returns. Here we have the rolling portfolio to beta to equity, which is the one I showed you earlier. And it has a lot of data, like in-depth analysis of your backtest data. These are all your positions over time, and we'll go down to the performance attribution section. So this is our net exposure. We see that we're net neutral over time. We had equal side long and short as we wanted. Here we have gross leverage. It stayed pretty close to 1 the entire time, which is good. Then these are our transactions time distributions. The time of day in which our algorithm try to fill orders. See that. So we try to place orders on market open, and then the distribution shows that some of them didn't fill right away, so they carried over the entire day. And this is our performance relative to common risk, performance attribution. So here we have our total returns, which is the blue line, our specific returns, which is what would be the residual returns, and the red are the common returns, or the returns that are attributed to common risk factors. So here we have our cumulative returns per common risk factor. We have 16 total. 11 of them are sector factors, and we have 5 style factors, which are volatility, size, momentum. And down here we can see our exposures to all of those factors. So this is pretty much the entire workflow you would follow. You would conduct research, the research environment, use query data, play around with it, run some statistical analysis on it. Then you would come up with a strategy based on your analysis. You would port that strategy to an algorithm using the pipeline API. And then you would build a trading logic using the optimized API. And you can analyze, finally, you can analyze your backtest performance. No questions. So things to do after that. One good thing you can do after following the Getting Started tutorial would be to go to the pipeline tutorial to get really acquainted with how pipelines work and all the awesome things you can do with them. Can submit your algorithms to the contest. Let's see. You can also build strategies for our fund. Currently, we're looking for strategies that meet this criteria. We have some positive returns, trade actively. We look at algorithms that trade between 12 and 500 times per year. algorithms that manage risk very well using the risk model API, pipeline, the optimized API. Another great thing you can do is go through our lecture series if you need ideas for strategies. The lecture series covers a lot of quant finance topics very well. Have 50+ lessons you can follow and some algorithm examples in there as well. So I don't know if you have any questions.
Yep. So we have received a few questions that we're going to answer now. Ernesto will go through them. If you have a question that hasn't been answered, please submit it in the text box on your control panel. If we don't get to your question today, because we have quite a few already, you can always email us at feedback@quantopian.com or events@quantopian.com, and we'll try to get your question answered for you. All right.
All right. So one question is, what instruments can I backtest? Currently, we support U.S. equities and 72 U.S. futures. We have a separate tutorial for futures. If you want to check it out, it's getting started with futures. You can find it. Learn tutorials. Getting started with futures. It's a really cool tutorial as well. I code in MQ4, MQ5. Can I use that code? No. In Quantopian, you have to use Python, the Python programming language. Everything uses Python. What is research memory? Research memory is just how much research in total all of your notebooks are using up. So if you're running a really, I don't know, if you're running an analysis that requires a lot of memory, a good thing to do is to shut down your notebooks. You can do that just clicking shut down notebook in your list of notebooks. That'll free up the memory. I have other notebooks running, that's why it looks so high. Forks is it? Well, super notebook. Yeah, so the Quantopian module is exclusive to the platform. If you want to work on your local environment, you would want to check out Zipline, which is our open source backtester, and you can find that on GitHub. So this is what powers our platform, and you can use it in your local environment. Let's see, write code, can you from when I write code, can you from Quantopian see it? Is it compiled on your servers? So all the code you write in our platform, whether it is in notebooks or algorithms, it's secret. It's encrypted in our servers. We do not have access to it. I would check out section 5 of the terms of use. There are some exceptions to that, but overall, we don't have access to it unless you give us permission for support or something like that. It's a common reason why we would, like, only if you give us permission because you're having trouble with the algorithm you want us to help out. So what do we have for cryptocurrency? Can I backtest on hourly or for hourly time frame instead of daily time frame? So all backtests are run on minute bar frequency. You can specify functions to only run daily if you want, but all the backtests are run at minute bar frequency. Can I integrate my data and codes with Quantopian code? You can import your own data using fetch_CSV. It's a built-in function in the platform. I would check out the help documentation for that. It allows you to import time series data for assets or signals, and you can integrate that into your algorithms, and you could combine that with your pipeline data and use it to choose the assets you want to trade and so on. Keyword shortcut to display Intellisense autocomplete. Is there a keyboard shortcut to display Intellisense autocomplete while coding? You can use tab complete. If you don't, it is possible that you disable it. But if you go to the settings, you can enable it back in. If you go to the ID, I'll show you in a bit. Or not. What's the algorithm API? Clone. So if you have this enabled, use tab complete. You can as you're writing, you can just hit tab and it'll show you a list of completions or valid completions for your code. Is there a technical analysis library? So we have the Talib library available for you to import, and it has a bunch of technical analysis functions you can integrate in your algos. So how can I go to the code? How can I go to the code inside an existing function? For example, look at the code inside simple moving average. So the simple moving average is part of our zipline code, and you can find that in our zipline repository. The pipeline API and the backtester are open source. You can find those there. You can find your pipeline, all our factors, filters, and other stuff in there. Supposed to define a new sentiment function. Is it possible to define a new sentiment function different from the one you used, so I can look for a specific type of information on the tweets? So yeah, the function I defined was just an example. I would recommend you using the research environment to check out what the stock tweets dataset provides. Some of the examples I showed was the bull minus bear score, the message volume. It has some other metrics in there, so you can look at them and you can build your algorithms pretty much in any way you want with the pipeline API. Let's see, another question. Let's see, is the ID available offline? It's pretty much the same question as with zipline. You can download zipline and work on your local environment. Where can I get a working model to practice? So you can get the example from the Getting Started tutorial. In our help documentation page, there are a bunch of examples, and you can get there on quantopian.com/help. At the bottom of that page, you can find a lot of example algorithms and some great algorithms also in the lecture series page. And you can get that from lectures. Here we have a more robust Longshore equity example. We have a pairs trading example here, Longshore equity. And you can clone this as well. So you can check out the code. You can clone the example and then just backtest it, analyze it. You can modify it and add more stuff to it. What time is end of day data for stock? So I think he means at what time what time is the data available? So the data is loading as of the most recently finished trading day. So for example, today we would have data up until yesterday. Is a Quantopian Python version 3? No, we use version 2. What is does the live data come on filter, or is it being filtered in real time before entering my algos? So I believe you mean for paper trading, and that's just 15-minute delay data, and there is no filtering being done in the data before it reaches your algo. Yeah.
Okay, great. So that's all the questions for today. Like I said, if you have a question or you want to learn more about the tutorial and you want to send us an email, you can do that, and Ernesto or someone else should be able to get back to you. Thanks everyone for joining. Thanks Ernesto for a great presentation. And yeah, keep checking your email because you will receive one from us with a link to the recorded version of this webinar and information about all of our upcoming webinars. So thanks for joining.